The difference between market weighting and smart beta is a couple fold. With market cap weighting, realize that what you're doing is you're weighting the companies based on their size and their market capitalization. With smart beta, you're taking that into account, but then you're also looking to harness compensated risk factors through your stock selection and your weighting in the companies. Both could be index-based, and both will use a rules-based process to harness those factors, or just market cap in the plain beta way.
In a world in which traditional active managers had such a tough time outperforming a benchmark index, how is it that smart beta purports to be able to deliver excess returns? And I think the real root of that gets at behavioral biases of investors. And I mean investors both in terms of professional investors as well as just retail investors. And that is the behavioral bias, the inclination towards what is comfortable. It's easy for investors to be invested in stocks that have risen in value recently. It's tough for investors to allocate into stocks or area of the markets, whether it's a sector or whether it's a country or whether it's an individual stock that that have underperformed recently. But one of the elements of smart beta that I think is just so critical to the mix, if you will, and that is that systematic rebalancing. The fact that it's removing market emotion, it's removing sentiment from the equation and simply systematically rebalancing based upon the methodology. So the removal of the emotion, if you will, I think is one of the key things that really helps to address the investors' behavioral biases.
We feel that the best way to select a smart beta strategy is to look at 4 criteria when you're evaluating the overall universe. The first is differentiation. What we're looking for is something that was unique, that could have a differentiated alpha, even when controlling for the known risk factors such as momentum, capitalization, or value. The strategy needs to be scalable. This is where market capitalization and liquidity matter. There are some factors out there that rely on small capitalization as a way to extract an additional return premium. However, the problem with small capitalization is, for those of you who have invested in small and mid-cap type companies, you realize that as more assets start to chase those sectors of the market, that the benefit that you had once with the small cap begins to disappear quickly. We look for a strategy that has a beta of close to 1, because at the end of the day, you do want to capture that market exposure.